Today I want to break down a pattern with you that shows up in day trading almost every single session. It doesn't matter whether you trade momentum, follow trends, or specialize in reversals. I'm willing to bet you've run into this one, which means almost everyone watching can use what we cover today. And the most dangerous thing about this pattern isn't simply that it tricks you into buying. What makes it genuinely dangerous is what happens right after you're in. Price tends to turn around very quickly, and that move against you is so fast and so sharp that you barely have time to react. In other words, the more it looks like a perfect opportunity, the deeper it ends up trapping you. The thing I'm describing is what we call a fake breakout, and today I'm going to walk you through it, one candle at a time, so that the next time, before you ever click buy, you can spot it for yourself. Before we look at any chart, let's start from the very basics, because that's the only way the rest of this is really going to land. In trading, there are two ideas you've probably heard more than any others, and they also happen to be the most useful: support and resistance. Put simply, support is the floor that price keeps falling to but can't seem to break below, and resistance is the ceiling that price keeps rising to but can't seem to push above. For most traders, where they buy and where they place their stop is built almost entirely around these two lines. To make today's pattern clear, let's use the simplest possible strategy as our example. It's called the breakout long. The idea behind it is very direct. We find the resistance that's most likely to break, we wait patiently for price to actually break through it, and then we buy in that direction to ride the momentum higher. So why does this make sense? Because when an important resistance genuinely breaks, all of those short stop losses sitting just above it get triggered one after another. That's what we call a short squeeze. And on top of that, a wave of breakout buyers piles in, so price gets pushed up very quickly. So I want you to understand one thing first. There is nothing wrong with this strategy itself. A real breakout really does behave exactly like this. The one hard part, the only hard part, is telling the difference. Is the breakout in front of you the real thing or a fake? So let's look at this chart together now, and you just follow my pace, one step at a time. You can see that price is slowly climbing the whole way up, and then it arrives at this very obvious resistance, a line that, honestly, everyone in the market can see. At first, price pushes up, but it quickly gets pulled back down. It doesn't break though, it just keeps holding near the line. Then it takes another run at it, and this time it actually clears it. Let's pause right here for a second. If you were the one sitting in front of the screen right now, wouldn't a thought start creeping in? It finally broke out. This is the move. The squeeze is about to kick off. I need to get in before I miss it. And the truth is, a lot of people do buy right here. Then we watch price steady itself for one candle up above, and then gently pull back just a little. And at this point, even more people want to get in, because the way they see it, price is now lower than it was a second ago, and it is pulled back once, which means they can get in at lower risk. So what actually happens next most of the time? Usually this. One long red candle comes slamming down almost out of nowhere, cutting straight back through the breakout level. And just like that, the people who chased it, plus the people who thought they were being smarter by buying the pullback, are all trapped at the same time, and they're losing money fast. And at this point, almost everyone's first reaction is exactly the same. I got hunted again. The institutions are just farming us retail traders. But is that really what happened? Here, I want to offer you a slightly different way of looking at it. Sure, there is big money in the market, and yes, there are all kinds of games being played. But the way I see it, if you compare it to just about anywhere else in the world, the market is actually one of the fairest places there is. And why do I say that? Because whether you are a giant institution, a fund, or an ordinary retail trader like us, the moment you do anything in this market, you leave a trace behind. And there are only two things that let us see those traces: price and volume. In other words, even if someone really did want to hunt other people, they would have no choice but to leave a clear set of footprints in the price and the volume. So what you slowly start to realize is this. The real question was never whether someone was out to trap you. The real question is that the footprints were sitting right there on the chart the whole time, and you just didn't see them. So now, let's go back and walk through that same stretch again, slowly. This time, watch the footprints that were there from start to finish. First, that early push left a long upper wick up top. Price reached up there for a moment, then got pressed straight back down by sellers, and that is a clear rejection. Then came the candle everyone called the breakout, and most people bought right here. It pulled back a little, and more people bought the dip, but noticed that it couldn't even hold above the line. And then the trap sprang. One long red candle broke the previous low, and everyone was caught at once. But here is the footprint that warned you before any of it. At the exact moment of that breakout, the volume actually shrank. There were no real buyers behind it. Price and volume. Those two footprints were sitting there in plain sight the entire time. So what should we actually do to keep from falling into this trap? Let me be clear first. The answer is not never trade breakouts again. The answer is don't go charging in on that first impulsive candle. Here are 3 rules you can start using the moment you finish this video. Rule 1. Don't chase the wick. Wait for the close instead. Let that candle finish completely, and only when price closes above the resistance and actually holds there do we treat it as a real breakout. If it just pokes up and then closes back under, that is a rejection, not a breakout. Rule 2. Always check the volume. A real breakout comes on volume that is clearly higher than the consolidation before it. So if what you are seeing is a breakout on shrinking volume, just pass on the trade and leave it alone. Rule 3. Learn to wait for the retest and the hold. A breakout that is genuinely valid will often come back to retest the level it just broke, turning old resistance into new support. And we get in right there, at the spot where it retests and confirms it is holding. The nice thing about doing it this way is that you not only sidestep the fake breakout, you also get to place your stop much closer. You could honestly write these 3 rules down and turn them into a checklist you tick through every single time before you click buy. But here's the thing. By this point, a voice in your head might be saying, I already know all of this. And that, right there, is exactly the point. Because the real problem was never that you don't know the rules. The real problem is that the instant that big green candle fires up and the whole market is screaming breakout, your hand moves faster than your brain. You are so afraid of missing out that you click first and remember your rules afterward. So you see, the hard part was never the knowing. It is whether you can actually hold the line in the moment your emotions take over. And that is exactly what Meridian is built to help you with. It watches your behavior in real time while you are actually trading. The moment it notices you starting to chase, your orders firing faster and faster, or you jumping in somewhere outside your plan, it steps in right then and tells you to stop and take a breath, catching you before that impulse ever becomes an order. It is not there to predict the market for you. What it is really doing is helping you hold the line that the calm version of you set down in the first place. So next time, before you click buy, stop and ask yourself one question. Is the thing in front of me a real breakout that closed, held, and came with volume? Or is it just a wick with no volume behind it? And tell me in the comments, how many times has a fake breakout trapped you so far? If you want the full entry checklist, I have put it in the link down in the description. And make sure you subscribe, because every episode we break down one more specific mechanism that is quietly costing you money. And do me a favor and hit like, because that one like might just help the next trader who is about to go chasing this exact breakout.